Imagine you own a small cafe. Everything it owns, cash, coffee machines, inventory, must be financed by either lenders or you, the owner. This idea is captured in one simple equation: assets equals equity plus liabilities. Today, we'll break down this equation and see how it connects to the financial statements. The accounting equation is the backbone of double-entry accounting. Assets are the resources you control, like cash and inventory. Liabilities are what you owe to others, like loans and payables. Equity is what's left for you, the owner, after liabilities are settled. Every transaction keeps this equation balanced. If one side goes up, the other must too, or something else must go down. The statement of financial position, or balance sheet, shows this equation at a specific time. On the left side, we list our assets, current and non-current. On the right side, we show equity and liabilities, usually listing liabilities first. For example, let's say we have cash $15K, inventory $5K, equipment $30K. Total assets equal $50K. Liabilities might be a bank loan of $20K and payables of $5K. Total liabilities equal $25K. Equity could be share capital of $20K and retained earnings of $5K. Total equity also equals $25K. So, we check. $50K in assets equals $25K in liabilities plus $25K in equity. Now, profit doesn't just sit on the balance sheet, it flows into equity, specifically retained earnings. We can expand equity to show assets equals liabilities plus contributed capital plus retained earnings. And remember, retained earnings equals opening. Retained earnings plus profit or loss. This means profit connects the statement of profit or loss to the statement of financial position. Profit or loss is calculated as income minus expenses from the P&L. When we make a profit, it increases retained earnings on the balance sheet. A loss decreases it. Let's look at some transactions to see how the equation stays balanced. If the owner invests cash, A goes up and contributed capital E goes up too. So we have A up equals L plus E up, balanced. If we buy equipment with cash, equipment A goes up, but cash A goes down. The net effect is zero, so L and E remain unchanged. Buying inventory on credit increases inventory A and payables L. Again, A up equals L up, still balanced. When we make a cash sale, cash A increases and inventory A decreases. Profit increases, which raises equity through retained earnings. So we see a net change in A and E goes up by the profit, still balanced. Paying wages decreases cash, A, and increases expenses, which reduces profit and equity. So we have A down equals E down, balanced again. Taking a bank loan increases cash, A, and loan payable, L. So A up equals L up, balanced. Now, let's tie it all together. During the reporting period, we record income and expenses in the statement of profit or loss to determine profit. At the end of the period, profit updates retained earnings in equity. Then, we present the statement of financial position with updated assets on one side and liabilities plus equity on the other. That's the accounting equation in action. For a quick exercise, let's start with A/50, L/30, EX20, and apply 3 simple transactions. First, the owner invests +5 cash. Next, we make a cash sale. Price +6, cost 3, inventory. Finally, we pay wages of 2 in cash. Starting with A50, L30, E20, after the investment, we have A55, L30, E25. After the sale, A becomes 58, L stays 30, and E goes to 28. After paying wages, A is 56, L is still 30, and E is now 26. And we check, 56 equals 30 plus 26, perfectly balanced.